Hello, ladies and gentlemen. I hope you're okay. I am the Acca tutor, Jerry Mtimkulu, and in this video, I welcome you all to Ifrs 3 Business Combinations, where we'll be discussing further issues to do with Goodwill. This video is a follow-up to our previous video on Group Statement of Financial Position. In that video, we touched a lot of things from the basics of consolidations, the workings involved whenever you're confronted with a consolidation question with regards to the statement of financial position. We did a lot and also explored the areas to do with the associates and symbol or trade investments. However, we discovered that from your feedback, we did not talk of certain issues related to Goodwill. And in this video, we are just going to do a sum up as well as to add some flesh to the area of Goodwill. Remember also, that we talked about Goodwill when we did a lecture on International Accounting Standard number 38, that is intangible assets, where we pointed out that internally manufactured goodwill is not considered or is not recognized as an asset, and only purchased goodwill is considered an asset. So in terms of IFRS 3 business combinations, goodwill from acquisition, goodwill from an acquisition of another business is considered an intangible asset. So the purpose of this video is for us to know more of how goodwill is is recognized, how it is manufactured from a purchase of another business. Okay, so without wasting much of your time, let us get straight to the business. Now, what happens normally is that the assets of an entity or of a business exceed the value of the business net assets. Okay, the value of an entity usually exceed the value of its net assets, and the difference thereof is considered goodwill. Okay, so in terms of International Financial Reporting Standard number 3, business combinations, this difference or this goodwill is recognized at the date of acquisition and accounted for as an intangible non-current asset. This represents assets not included in the statement of financial position of the acquired entity, such as the reputation of the business. Okay, these are intangibles. However, they were not recognized by the acquired business because International Accounting Standard number 38 prohibits such recognition because there would be internally manufactured brands or internally manufactured goodwill. Okay, they are not recognized, okay, because the business had not been sold. All right, the experience of the employees and so forth, those ones are not recognized by the business because they would be internally manufactured. But upon the sale of the business, the acquirer is allowed to recognize them as intangible assets in the form of goodwill. So basically, goodwill arises because the investor would rather buy a ready-made and established business than buy the individual components and set up the business themselves from nothing. So you could see that goodwill, this sometimes is called premium on acquisition. Premium on acquisition. Why? Because there is a cost. There is a cost involved in buying an already manufactured something. Okay, you are buying a complete business that has been a product of many years of marketing, many years of loyalty from employees, uh, critical management skills, and so forth. So you just can't get that for free. Okay, in as much as you have paid for this particular business assets, you need to pay a premium on top of that. And this premium is usually explained by the reputation of the business, okay, the brand, and the experience of the business employees. Okay, so you are buying something that is ready for the market. You are buying something that is just ready to go. All right, so you are going to incur some premium expense. Okay, so this is why goodwill is considered premium on acquisition. Now, how do we account for goodwill on consolidation? Now, firstly, in the books of the parent company on consolidation with subsidiary as co, the following entries are made. You are going to debit the investment in ESCO. Okay, that's, you debit the investment. By debiting the investment is you are recognizing the investment. You are recognizing the subsidiary, okay, as part as an asset to the parent company. Okay, remember in the previous video on the group statement of financial position, we discussed issues related to how or when consolidation should be recognized, okay, or should be considered to have occurred. We said that one of the entity should have acquired a controlling stake in another entity. So that entity that is now being controlled is a subsidiary. It could be a complete control or partial control, but for example, any acquisition of more than 50% shareholding, equity shareholding, where there are some voting rights, then automatically that is considered a subsidiary, an acquisition of a subsidiary. Okay, so when such an event occurs, you have to debit the investment in subsidiary, okay, and credit the bank if you had paid for this acquisition with cash or by cash. Then in the group records, we are going to revisit these entries where when we talk of other forms of consideration. Okay, here we just believe that the acquisition was through the payment of cash, okay, or the use of our bank where we transfer funds from our bank. This is why we are crediting the bank, because we have transferred funds out of the bank as we purchase this particular subsidiary. Now, in the group financial statements, what we are going to do is we are going to debit goodwill only. We are going to debit goodwill. So in the view of the group, we are not seeing the investment per se, but we are seeing the ultimate goodwill. Okay, so to the group, we are seeing the ultimate benefit. We are seeing the goodwill. All right. So we are going to debit goodwill and credit bank. Okay. But if you still remember here, this is a very interesting part where I want this video to be useful to you. Okay. You will see that in my initial explanations to this video, I say that goodwill is the premium on acquisition, which means we would have, when we transfer money, okay, the consideration we transfer would be for the assets of the company, plus premium. Okay, so the consideration would be for the assets as well as the premium. That's what normally happens. Okay, what normally happens is we pay for the assets of that business, okay, which are recognized in their books in terms of accounting standards. All right, plus other assets which are not recognized, and that's the premium, and that's the goodwill we are talking about. All right, so in this case, the assets could be, let's say, for $60,000, and this premium could be for $20,000. So obviously the total consideration that has been paid should be $80,000. So how come now we are saying in the group records we are only going to record the premium, the goodwill of 20, okay, thousand, vis-a-vis a consideration that has been transferred of 80,000? How come? Why are we saying that? So basically, there is a background, okay, there is a background debit entry, okay, there is a background debit entry. You see, I will be explaining through an example. There is a background, okay, there is a background double entry, a debit entry where we debit the assets of the subsidiary, assets of subsidiary, 60,000. Okay, that 60,000 would be somewhere in the non-current assets. Okay, you will see that one. Okay, don't worry, we'll reach there. Don't worry, just hang on, as I will be explaining where those assets would be, or where that entry could be seen or could be traced to. Okay, now before we go to that entry, let us talk of various entries that could be made with respect, in respect of the consideration, as we try to recognize this acquisition. Okay, so we say that initially we recognize this particular entry in the records of the parent, okay, where we say that we debit investment in the subsidiary escrow and credit bank. But you will discover that sometimes we do not acquire these subsidiaries by cash. Sometimes we do a share for share exchange. Sometimes we just enter into some loan agreements, or sometimes we do some contingent considerations and so forth. Okay, if the consideration transferred is in the form of cash, we simply have to debit investment in escrow and credit bank. Okay, if share exchange, if there is a share exchange, we credit share capital and or share premium. Okay, so if we do not acquire by cash, but we entered into a share for share exchange, we then have to credit share capital. Okay, so we are going to debit. Sorry, let me look for another pen. We're going to debit, okay, investments in S in subsidiary, okay, and credit share capital, and usually together with the share premium. All right, that's what happens. But sometimes we acquire through the issue of loan notes or bonds. In that case, we are going to credit loan notes. All right. Sometimes it might be in some deferred consideration, that is, we are going to pay in later years. We are going to pay the consideration in later years. Um, in that situation, we are going to credit deferred consideration or liability, which has to be in present value terms and has to be unwound. So you discover that the rest of these matters are no longer part of the FA syllabus, okay, the Acca financial accounting syllabus. Those ones, some of these are going to be dealt with in advanced level studies, that is from financial reporting up to the strategic business reporting modules. So do not worry about those ones. I hate you guys, complaining that what if some of these considerations are not cash? How are we going to solve those exam problems? You just have to just take a snapshot of these explanations. So they are very useful in that regard. Okay, they are very useful. Okay. One thing you have to understand is that sometimes the consideration could be in twofold or threefold. For example, the part of the consideration could be through cash and then through share for share exchange and so forth. You just have to know how to compute and the relevant entries to be met. Okay, you first have to deal with the consideration for the cash, then you have to compute for the share for share in terms of the value. And remember, you need to originate the proportions. Okay, if it is that the parent company is going to transfer 3 out of 2 shares, or 3 for every 2 shares in the subsidiary, then you need to determine that the proportion is 3 over 2. Okay, 3 over 2 multiplied by the parent share price. Okay, multiplied by the share price of the parent shares. All right, not the share price of the subsidiary shares, but the share price of the parent multiplied by the number of the percentage of shares acquired. If it means that they've acquired 80% of the shares through a share for share exchange, you then have to multiply by 80%, multiply by the number of shares in the subsidiary, and you get the value of the consideration. We discussed about those ones, those items in the previous video. Okay, we tackled the share for share exchange, although we did not tackle the issue to do with other forms of consideration. Okay, but do not panic if you are an Acca FA student. Those items are going to be covered. The rest of these other items are not going to be part of the syllabus. Okay, now let's discuss this example as we try to answer the issue of the double entry I pointed out earlier that we are going to discuss on. All right. In this particular example, Pedro Co. We are told that Pedro Co. purchased all of the share capital, that is $40,001 shares of Syracuse Co. for $60,000 in cash. The statements of financial position of P Co. and S Co. prior to the acquisition are as follows. Okay. Now, the statements of financial position as at 31st December 20x1 are as follows. We have got Pedro, that is P. Okay, this is our P, and Syracuse, this is our S. Okay, that's Pedro the parent, Syracuse the subsidiary. Okay, and we are told in the question, in the introduction there, that the parent purchased all of the share capital, that is 40,000. Okay, $1 shares. So 40,000 shares were all acquired. Then we are given the information of the non-current assets. The non-current assets are made up of the property, plant, and equipment, 100 for the parent and 40 for the subsidiary. And then the cash at the bank for the parent was 60. Okay, so initially this was the setup, and the equity and liabilities, we had share capital. Okay, we had share capital of 160 and then 40 for the subsidiary. All right, 160 for the parent and 40 for the subsidiary. So if you can see, if you look at this these statements of financial position, you could see that they were all balanced. Okay, they were balanced. All right, 160, 160. Okay, 160 for the assets and 160 for equity and liabilities, and then 40, 40. All right, so this was the setup in each individual companies. All right, but then after the purchase, we need to see some change in terms of the individual balance sheets. Okay, because we are told here that the purchase consideration was cash. Okay, uh, they paid cash for this acquisition. Okay, so we are expecting to see some changes within the cash balances. All right, we are expecting to see some changes in the cash balances, as well as the uh, property, plant, and equipment, or in general the non-current assets. We also want to see them changing. Okay, but we are not likely to expect to see some changes with regards to the share capital. Okay, because the share capital in this case was not moved. The purchase consideration was in the form of cash. Okay, but if it was in the form of some share for share exchange, we're expecting to see some increase in the share capital of the parent, because it would have issued further shares to acquire this particular subsidiary. Okay, let's move. So we need to examine the entries made within the parent company, okay, in its own statement of financial position. All right, when it acquires the shares in Syracuse. So remember, our first entry in the parent company's records is we are going to debit the investment in the subsidiary, 60,000, and then we are going to credit bank because we have transferred money, 60,000. So initially we're having the 60,000 here in the parent company. So we are expecting to see this 60,000 not there for now. So obviously, in the individual statement of financial position for the parent, we are going to see property, plant, and equipment. Okay, we are having 100, and then investment in Syracuse core, 60, and we are not going to entertain the existence of cash again, because we have used that cash. Remember, we were having cash at bank, but we have used this cash to acquire the subsidiary Syracuse, so therefore we no longer have that cash. Okay, we no longer have the cash, but we now have the subsidiary. The asset cash is gone. We now have the subsidiary Syracuse. So in the individual, in the parent's individual statement of financial position, we are going only to see the this investment in Syracuse. Why? Because we have debited investment. As you can see here, we have debited investment and credited bank. Okay, so by crediting bank, we were canceling the bank balance, all right, and recognizing the investment in Syracuse Co. Okay, that's what was happening. Okay, now, okay, so you can see that the share capital was not disturbed. Okay, the share capital was not disturbed. It is still 160 within Pedro. So that's the individual statement of financial position for Pedro. Now let's move on to what happens with the group statement of financial position. Now, when the directors of Pedro agreed to pay 60,000 for the 100% investment in Syracuse, they must believe that in addition to Syracuse non-current assets of 40,000, remember Syracuse had non-current assets of 40,000, okay, but they paid how much? They paid 60,000, okay, which means they were believing that on top of those non-current assets, uh, Syracuse Co must also have intangible assets worth about $20,000. That was their belief when they were entering into this particular transaction, maybe because they have heard of a good trading history of Syracuse, good customer care, good managers, experienced or technical, fintechs within these um, within Syracuse. Okay, there were some financial, there were some financial expertise. There were some good managers. There were some good brands and some customer relationships management, which were so above board, uh, which they admired, and they were prepared to pay for those uh, attributes. Okay, so they paid 20,000 on top of the 40,000. Okay, so the total, this gives a total of 60, obviously. So this amount of 20,000 paid over and above the value of the tangible assets acquired is called the goodwill arising on consolidation, and sometimes called premium on acquisition. So following the normal cancellation procedures, the 40,000 share capital in Syracuse Co statement of financial position could be cancelled against 40,000 of the investment in Syracuse Co. Okay, so when we were recognizing the 40,000 as investment in Syracuse Co, we were also canceling, we were also debiting the the share capital in Syracuse Co, because we are now acquiring Syracuse Co. It's no longer an independent entity, so it no longer have its own share capital. Independent share capital. So we were debiting, we were closing, and when we were debiting their share capital, we were crediting our own here. Okay, that's what was happening. So what this simply means is that when the parent acquired a stake in the subsidiary, in this case it wholly acquired the subsidiary, so it means that the share capital of the subsidiary was had to be cancelled. All the share capital of the subsidiary had to be cancelled for the purpose of consolidation. So the 40,000 we were seeing in the subsidiary, okay, let us open the subsidiaries. Yeah, this one. Now we're seeing this 40,000 share capital which was acquired. So this 40,000 was acquired, okay, and we paid 60,000. all right, which means there is um, also a 40, a 20 somewhere here, okay, so such that 40 plus 20 gives us 60, okay, and we are saying um the 40,000 here is cancelled, okay, the moment we recognize an investment in S of 40,000, as we have recognized it here, okay, we have recognized um of 60,000 rather, okay, the 40,000 is cancelled the moment we recognized an investment of 60,000, okay, but we are saying this 60,000 is made up of 40, which was the share capital which we acquired, plus the 20, which was the premium, okay, the 20 was the premium, okay, so the 40,000 has to be cancelled, okay, the 40,000 has to be cancelled in the statement of financial position of this particular subsidiary, okay, because its share capital was originally 40,000 and we paid 20, all right. Now one thing we have to know, or we have to appreciate here, is that when we pay for the subsidiary, we are not only paying for goodwill, but we are also paying for the assets of this particular subsidiary, which could have been recognized in their records. As you can see in the Syracuse case here, you can see that in their statement of financial position, they were also having assets of 40,000. Okay, they were having assets of 40,000. So we transferred to them 60,000. Okay, we transferred to them 60,000. All right, for the share capital. So automatically we are saying they are no longer independent. Okay, the 40,000 share capital has been acquired. Okay, they are no longer independent, so it has to be cancelled. All right, and we have to recognize that acquisition. Okay, we have to recognize that acquisition. So this statement, as you can see here, that following normal cancellation procedure, the 40,000 share capital in Syracuse core statement of financial position could be cancelled against $40,000 of the investment in Syracuse. Remember, the investment in Syracuse, according to our parent say statement of financial position, is 60,000. All right. So the moment we recognize this investment, we are saying we are canceling the subsidiary share capital. Okay. So which means our entry is like this now. Okay, we are we have debited investments 60,000. Okay, and we have credited. Okay, we have credited the bank. Okay, we have credited the bank with the consideration which we have paid. We've paid about 60,000. Okay, we've paid 60,000. Oh, sorry, my 60K. All right, but in this investment, as you can see, in this particular investment, we had paid for 40,000. All right, 40,000 was for the shares. All right, we paid for the shares. All right, so the investment in actual fact was for the 40,000 shares, which means there is goodwill we need to consider as well as our balancing figure. Okay, what I mean is the investment was for the shares. Okay, we had acquired 40,000 of those shares. All right, so um, in our records, the cancellation is to cancel this share capital of the initial subsidiary. Okay, the initial subsidiary, I mean the former or the acquired company, the Syracuse company. All right, we had to debit their share capital rather. Okay, we have to debit their share capital of subsidiary of Syracuse. All right, so by debiting their share capital, we are canceling out their share capital. All right, we are canceling their share capital because um, we need to close them. All right, and we also have to recognize the goodwill of 20,000. So this is why we are having this particular statement of cancellation procedures. The cancellation that was happening, we are debiting the share capital of sub. Okay, the share capital was 40,000. This pen of mine. Okay, the share capital was 40,000. Okay, and we credited the bank, we paid 60,000. So automatically you can see that there is a missing entry that is to be made, which should be the goodwill. So such that the debit and the credit have to balance. Okay, so this is why I say that this entry is actually a background entry from our initial assessments, initial double entries here. I say that the entry which you are going to see in the textbook is that you debit goodwill and credit bank, but you realize that the bank could have, the amount that we could have or we would have transferred is actually larger than the goodwill, because goodwill is just the difference after we put into consideration, or after we take into consideration the assets acquired. Okay, so the excess or the difference would be the goodwill. So this is likely to be lower than the consideration transferred. Okay, so we need to know what happens to the other, to the net assets. How much were they? And I hope by this presentation so far you have appreciated that the other difference or the other assets could have been the assets of the subsidiary acquired, or the share capital of the subsidiary. Okay, so the cancellation happens in the manner that we have to cancel out the share capital of the subsidiary because it is no longer part of the subsidiary. Okay, or the subsidiary in this case has been closed out. Okay, it has been acquired. It's no longer an independent company. It's now part of the group. It's now under the parent's control. Therefore, we have to cancel out its share capital. Okay, so we debit the share capital of the subsidiary. By debiting the share capital, we are closing out, we are canceling out, and we have to then we'll be left. So as you can see here, if we cancel out this the share capital of the subsidiary, okay, we are going to be left with the only one debit entry which we are going to be left with would be for the goodwill. Okay, as you can see also that this okay, all right, let us look at this at this problem this way. We know that the investment in Syracuse Co was 60,000, okay, but the share capital of Syracuse was 40,000, okay. Now, in the individual records of the parent, we had recognized the investment in Syracuse Co as 60,000. Okay, now we want to consolidate, okay, which means we want to move this information to the group. Okay, we want to move this information to the group. Okay, what we know is that for us to consolidate Syracuse to the group, okay, we had to close its share capital. We have to cancel share capital, cancel share capital of Syracuse. All right. So if we cancel the share capital of Syracuse, we have to do that one by canceling also the investment. Okay, the equivalent investment in Syracuse Co. So the investment, the share capital was 40,000. So the 40,000, the equivalent 40,000 in this investment has to be cancelled. So you have to cancel 40,000 in the investment or of the investment in Syracuse Co. So which means this means we are only left with 20,000 goodwill. Okay, so this is why normally we record a double entry that says debit goodwill and credit bank. Okay, the bank would have in the bank or from the bank would have transferred a total of 60,000. Okay, but this 60,000 includes the share capital price of 40,000 plus the goodwill. Okay, but because for the purpose of consolidation, our share capital is not going to increase, but rather we are only going to cancel the subsidiary share capital of 40,000 and part of the investment in the subsidiary of 40,000, such that we are only going to be left with 20,000 to be recognized in the group statement of financial position. Okay, all right, so that's what happens with these consolidations. All right, so only goodwill is going to be left, which is 20,000. However, I need to point out that there is a background 40,000 you need to know. After we cancel this, we have cancelled the share capital and we have also cancelled part of the investment in the subsidiary. Okay, some debit is somewhere. Okay, some debit is somewhere in the PPE. Remember, this asset was, this subsidiary had assets. Okay, this subsidiary had assets. Okay, so in the eyes of the group, we don't recognize the investment per se. We don't have this entry in terms of Ifrs 3. Okay, but we have got an entry for the assets of the subsidiary. So you discover that the other background debit to make sure that our debits and credits balance is for the assets of the subsidiary, which is 40,000. So let us finish this example so that you see where these assets could be located. Okay, as we go down with our example here, you could see that the property, plant, and equipment had increased with $40. Okay, the parent P had 100, then subsidiary had $40,000 worth of assets. So if we come here, you could see that there were also assets of 40. When we paid for the 40,000 these shares, they were also equivalent to the 40,000 assets, as you can see there. So while we cancel out in the consolidation, we cancel this against the investment of 60, okay, which means there was a $20 goodwill. But you can see that we can reconstruct the 60 by adding the 40, okay, such that we are just playing around with the figures. Okay, so you can see that the background, the other part of the debit entry was for the assets. Okay, this one is not normally mentioned, okay, but in theory, okay, not in theory actually, but what would have happened is that we would have also recognized the assets of the subsidiary. So the rightful entry is actually debit goodwill, debit the assets of the subsidiary, and credit the bank. That's the actual entry that would have happened. Okay, that's the actual entry that would have happened, as you have seen here, as you can see here again, that the assets of the subsidiary are being recognized, okay, and we end up having a 140 from the original. The parent statement of financial position was only having PPE of 100, okay, but because of the acquisition, the assets have increased to 140, okay, in the eyes of the group. Then the intangible non-current asset goodwill arising on consolidation is 20, okay, and then you can see that the rest is just as normal. Okay, now let us do an example where we do some computation of this goodwill so that we close the chapter. Okay, we've got this question. The statement of financial position of D&J as at 31 December 2028 is as follows. So we've got D and J there, their assets. We are told that D acquired an 80% holding in J on 1 January 2028. At this date, J's retained earnings stood at 20,000. On this date, the fair value of the 20% non-controlling interest in J was 12,500. Calculate the goodwill arising on the acquisition of J. Okay, so we need to just determine. We know that our first, from the previous video, we start with our working one. Okay, working one. This is the group structure. Group structure. That's our working one. And we know that we purchased 80%. So D purchased J, 80% of J, which means our NCR is equal to 20%. Okay, working number 2, the net assets. Net assets. Okay, and it is good practice to separate these net assets at acquisition and at reporting. Okay, reporting. And then we know that the first net asset to to pick is the share capital. The share capital is not expected to change. So for the subsidiary, the share capital for the subsidiary was 20,000, as you can see there. So it's not expected to change. It is going to remain as such. Similarly, the share premium is not also expected to change. And then we need to worry of about the retained earnings. They were 20,000 at acquisition, but they had moved to 25,000. Okay, so let us write the 25,000. Okay, all right, there are no other fair value adjustments, so we just have to add these figures up. We've got 50,000 here. We've got 20 plus 10 plus 25, that is 55,000. So there has been a movement of 5,000 in the retained earnings. Okay, then goodwill, working number 3, that's goodwill. The goodwill, we start with the fair value of consideration transferred, and the question is saying from the question, okay, the examiner in this case did not tell us exactly or expressly or explicitly, okay, did not tell us clearly or explicitly, so we need to just make some reasoning. Okay, so you go straight into the statement of financial position and locate where it is written investment in J. Okay, investment in J. Sometimes if they simply say investments, that could be a trap because you do not know what type of investments were they. Some could include the investment in the subsidiary and something else. So you need to be careful. The wording of the examiner should lead you. So in this case, they have explicitly said that this investment was for the in the subsidiary. So we assume that the $60,000 we are seeing there is the purchase consideration or the consideration transferred. So 60,000. Then fair value. Okay, the fair value of NCI. The examiner had said that this was 12,500. 12,500. Then less fair value of net assets at acquisition. Okay, fair value of net assets at acquisition, that's working number 2, that's 50,000 from our working number 2, that's 50,000. So if we use our calculators, we get a goodwill of 22,500. My pen, sometimes my pen sticks. It's an old computer. 22,500. This is the goodwill at acquisition. Okay, so I hope, ladies and gentlemen, I have attended to your needs. Although there has been some lot of explanations, I was hoping to just clearing the air, but I guess I did not end up confusing any of you guys. Okay, one thing you need to remember is that here everything in terms of International Financial Reporting Standard number 3, business combinations. Everything is in fair values. Fair values, okay? Fair value of consideration transferred, fair value of non-controlling interest at acquisition, less fair value of net assets at acquisition, and then we have got the goodwill, okay, at acquisition, and obviously this will be the fair value of the goodwill. So I hope that is that okay. If you feel you need more coaching and you want me to be your Acca tutor or Acca and Finance tutor or your Oxford Brookes University registered mentor, I'll always be there for you. Okay, so until next time, may you continue to feel excited, very, very excited. I'm signing out. Thank you.